What if I told you one of America's biggest lenders quietly walked away from nearly $700 billion in U.S. government debt? Not because it wanted to, but because it had to. And in the process locked in losses most people still don't understand, losses that could reshape currencies, interest rates, and even the price of gold and silver you see on your screen every day. This isn't a rumor, it isn't a theory, and it didn't happen overnight, but the consequences are only starting to show. For years, China was the single largest foreign holder of U.S. Treasuries, the backbone asset of the global financial system. At its peak around 2013, China held roughly $1.3 trillion worth of U.S. government bonds. These weren't speculative bets. Treasuries are supposed to be the safest asset in the world, backed by the full faith and credit of the U.S. government, used by central banks to park reserves, stabilize currencies, and manage trade flows. Fast forward to today, and China's reported Treasury holdings have fallen to roughly the mid-$700 to low $800 billion range, depending on the month and how offshore custodians are counted. That difference, roughly $688 billion from peak to trough, is the exit we're talking about. And here's the critical detail most headlines skip. Much of that selling happened as bond prices were falling, which means China didn't just leave, it left at a loss. To understand why that matters, you need to understand how bonds actually work in real life, not in textbooks. When interest rates rise, existing bonds fall in price. Think of it like buying a house with a fixed mortgage rate right before rates shoot higher. Your house didn't change, but new buyers can get better deals elsewhere, so your resale value drops. From 2021 through 2023, U.S. interest rates rose at the fastest pace in over 40 years. The Federal Reserve pushed short-term rates from near zero to over 5% to fight inflation. Long-term Treasury yields followed. That caused one of the worst bond market drawdowns in modern history. Even conservative estimates show long-duration Treasuries losing double-digit percentages in market value. When China sold during this period, it was often selling bonds worth less than what it paid for them years earlier. So why would a country accept losses on what is supposed to be its safest reserve asset? The answer sits at the intersection of geopolitics, trade, currency defense, and a quiet shift in how global money works. China runs a massive export economy. For decades, it recycled trade surpluses into U.S. Treasuries to keep its currency competitive and its reserves liquid. But that system started to break down. Trade tensions with the U.S. escalated. Sanctions became a real financial weapon after events like Russia's reserves being frozen. Suddenly, holding too many dollar-based assets carried a political risk, not just a financial one. At the same time China faced pressure at home, capital outflows increased. The property sector, a major pillar of Chinese growth, began to crack under debt. To stabilize its currency, the yuan, China needed dollars. Selling treasuries is one of the fastest ways to get them, but here's the trap. Selling large amounts of treasuries into a falling bond market pushes prices down even more, locking in losses and potentially driving yields higher. Higher yields raise borrowing costs for the U.S., but they also reduce the market value of the remaining bonds China still holds. It becomes a feedback loop. Now layer in inflation. From 2021 onward, U.S. inflation surged to levels not seen since the early 1980s. Even if China had held every bond to maturity, the real purchasing power of those dollars was being eroded. Imagine lending someone money at a low fixed rate, then watching prices rise 6, 7, 8% a year. You might get your dollars back, but they buy a lot less. From China's perspective, that is a hidden loss on top of the visible market loss from falling bond prices. This is where the phrase record loss comes into play. It doesn't mean China publicly announced a single realized loss number on a balance sheet. Central banks don't report that way. It means that relative to historical norms, the combination of price declines, negative real yields after inflation, and currency management costs created one of the worst outcomes for a major sovereign ND holder in decades. And China wasn't alone. Banks, pension funds, and even U.S. institutions suffered during this bond rout. The difference is scale. When you are talking about hundreds of billions of dollars, small percentage moves translate into massive absolute losses. So what did China do with the money it pulled out? This is where things get interesting. Some went into shorter duration assets to reduce interest rate risk. Some was used directly to support the yuan. Some likely moved into non-dollar assets, including gold. Official Chinese gold reserves have been rising steadily for years, with consistent monthly purchases reported by the People's Bank of China. Gold doesn't pay interest, but it also can't be sanctioned, defaulted on, or printed. For a country worried about financial sovereignty, that matters. This shift has implications far beyond China. If the largest foreign holder of U.S. debt is stepping back, who fills the gap? domestic buyers, the Federal Reserve, or other countries. Each option carries consequences. More domestic buying can crowd out private investment. More central bank buying risks reigniting inflation. Relying on other foreign buyers assumes they don't share the same concerns China has. And here's the uncomfortable question. If treasuries are no longer the unquestioned safe haven they once were, what replaces them? This is where precious metals enter the conversation in a way that feels less like speculation and more like insurance. Gold has historically been a hedge against currency debasement and geopolitical risk. Silver, often called gold's volatile cousin, adds an industrial demand layer tied to energy transition and technology. When trust in paper promises weakens, even slightly, capital looks for assets that don't depend on anyone else's balance sheet. That doesn't mean the dollar collapses tomorrow. It means the margin of safety is thinner than most people realize. The $688 billion exit isn't about one country making a bad trade. It's about a slow-motion restructuring of the global financial system, where risk is being reassessed, alliances are being tested, and assets once considered boring are suddenly volatile. When you see Treasury yields spike, when you hear about central banks buying gold, when silver starts moving in ways that don't match the stock market, these are all pieces of the same puzzle. The question is not whether this shift is happening. The question is what it means for your savings, your investments, and the system you rely on every day, starting right now. Now, the reason this story matters so much is that it forces us to confront how fragile the assumptions behind the modern financial system really are. Because for decades, investors were trained to believe that U.S. Treasuries were not just safe, but immune to the kinds of risks that apply to everything else. And China's exit shatters that illusion in slow motion. To understand the deeper consequences, you have to zoom out and see how treasuries function as the plumbing of global finance. Banks use them as collateral, central banks use them as reserves, and markets use their yields as the reference point for pricing everything from mortgages to corporate debt. When the largest marginal buyer steps back, even gradually, it changes the entire equation. Let's talk about yields for a moment, because this is where the pain becomes visible. When China sells treasuries, supply increases in the market. More supply with the same or weaker demand means lower prices, and lower prices mean higher yields. That's not theory, that's mechanics. Over the last few years, the U.S. 10-year Treasury yield surged from under 1% to levels above 4%, something that would have been unthinkable during the era of quantitative easing. Higher yields sound good if you're a saver, but they are brutal if you're a borrower, and the U.S. government is the largest borrower on Earth. Every percentage point increase in average borrowing costs adds hundreds of billions of dollars to future interest expenses over time. So China's exit, even if it wasn't coordinated or aggressive, contributed to an environment where servicing U.S. debt became far more expensive. At the same time, the Federal Reserve found itself trapped. On one hand, it needed higher rates to fight inflation. On the other, higher rates crushed bond prices and stressed banks, as seen in the collapse of several regional institutions that were loaded with low-end duration treasuries bought at low yields. This is exactly the kind of risk treasuries were supposed to eliminate. When even risk-free assets can destabilize banks, confidence erodes. China watched this happen in real time. From Beijing's perspective, holding massive amounts of U.S. debt now meant exposure not only to inflation and interest rate risk, but also to policy risk. Decisions made in Washington directly impacted the value of assets held thousands of miles away. There's also the currency angle, which is often misunderstood. When China sells treasuries, it receives dollars. To support the yuan, it may sell those dollars and buy its own currency. But selling dollars weakens the dollar relative to other currencies, at least at the margin. A weaker dollar can push up commodity prices, including oil, gold, and silver, because they are priced globally in dollars. This creates a subtle but powerful feedback loop. China reduces treasury exposure to protect itself, but the act of doing so contributes to forces that undermine the dollar's dominance, even if only incrementally. No single move breaks the system. 1,000 small moves slowly change it. Historically, reserve currency transitions don't happen overnight. The British pound didn't collapse in a single year. It faded over decades as Britain's economic dominance waned and its debts mounted. The dollar today still benefits from deep markets, military power, and global trust, but trust is not binary. It exists on a spectrum. China's actions signal that trust is being recalibrated. And when the second largest economy in the world recalibrates its trust, others pay attention. This brings us back to gold and silver, not as speculative trades, but as barometers of confidence. When central banks buy gold, they are making a statement about the limits of paper assets. Over the past decade, central bank gold purchases have hit multi-decade highs, with China among the most consistent buyers. Gold sits outside the credit system. It has no counterparty risk. Silver, while smaller and more volatile, shares this monetary history, while also being essential for solar panels, electronics, and emerging technologies. That dual role makes silver uniquely sensitive to both monetary stress and industrial demand. When you see silver spike during periods of financial uncertainty, it's often because it reflects both fear and growth expectations colliding. Another overlooked aspect of China's exit is the signal it sends about liquidity. Treasuries are liquid until everyone tries to sell at once. The bond market is enormous, but it's not infinite. During periods of stress, liquidity can vanish, spreads widen, and prices gap lower. China learned this lesson during the bond rout. Selling too fast would hurt itself. Selling too slow would leave it exposed. The result was a measured, a persistent reduction, a strategy that minimized disruption but couldn't avoid losses entirely. That's why this exit unfolded over years, not weeks. Meanwhile, the U.S. Treasury continued issuing debt at a record pace to fund deficits. That meant more bonds chasing fewer willing foreign buyers. Domestic institutions absorbed much of it, but at the cost of balance sheet stress. The Federal Reserve stepped back from being a buyer of last resort, at least officially. This is a radically different environment from the post-2008 ERA, where central banks suppressed volatility and backstopped markets. Volatility is back, and it's structural, not temporary. Ask yourself this question. If you were managing hundreds of billions in reserves, would you want all of them tied to a single issuer whose debt is rising, whose politics are polarized, and whose currency is being actively devalued by inflation? China answered that question with its actions, not its words. And actions matter more than press releases. For everyday investors, this might feel distant, but it's not. Mortgage rates, car loans, credit cards, and even job growth are all linked to the cost of money set in the Treasury market. When yields rise, everything reprices. At the same time, assets that protect against currency erosion become more attractive. This is why conversations about diversification are shifting away from pure stock and bond mixes toward real assets, commodities, and precious metals. The $688 billion exit is a warning shot, not a catastrophe. It tells us that the old playbook no longer works automatically, that risk-free is no longer are free of risk, and that global players are repositioning for a future that looks less stable than the past. The real question is not whether China was right or wrong to sell. The real question is what happens if others quietly reach the same conclusion, because once confidence shifts at the sovereign level, it rarely stops with just one player, and history shows that financial systems change not through dramatic collapses but through a series of rational decisions that collectively rewrite the rules. This is why China's move matters so deeply. It wasn't emotional, it wasn't impulsive, and it wasn't about headlines. It was about risk management in a world where the definition of safety has quietly changed. When the largest creditor to the world's biggest debtor starts reducing exposure despite taking losses, that tells you something fundamental about how the future is being priced. Consider the scale of U.S. debt today. Federal debt has moved beyond $34 trillion, growing faster than GDP, and deficits are no longer tied to recessions or emergencies. They are structural. Every year, the Treasury must roll over existing debt and issue new bonds just to keep the system running. This works smoothly when demand is strong and rates are low. It becomes fragile when rates are high and buyers hesitate. China stepping back didn't cause this problem, but it removed a stabilizing pillar that markets had relied on for decades. Think of it like removing a shock absorber from a speeding car. The road didn't change, but every bump now feels sharper. Now look at what replaced that lost demand. Us households didn't suddenly become massive buyers of treasuries. Foreign allies increased purchases at times, but not at China's scale. The Federal Reserve, after years of quantitative easing, began quantitative tightening, allowing bonds to roll off its balance sheet. That left primary dealers and banks holding more inventory, increasing systemic risk. This is one reason why volatility in the bond market has begun to resemble volatility in equities, something almost unheard of in the past. When the foundation shakes, everything built on top of it feels unstable. This environment naturally pushes capital toward assets that don't rely on promises. That's why gold's role is changing from an alternative investment to a strategic reserve again. Central banks aren't buying gold because they expect quick profits. They're buying it because it settles outside the system. No counterparty, no sanction risk, no maturity date. Silver, while often treated as secondary, plays a similar psychological role for private investors, with the added twist of industrial necessity. Every solar panel, electric vehicle, and advanced electronic device uses silver. So while gold reflects monetary fear, silver reflects monetary fear plus future demand. That combination makes it volatile, but volatility is simply information moving faster. Another consequence of China's exit is the GRA. Dual fragmentation of the global financial order. Instead of one dominant reserve asset, we are moving toward a more diversified system. More bilateral trade settlements, more regional currency arrangements, more commodities used as settlement tools. None of this replaces the dollar overnight, but each step reduces dependence on it. The dollar remains dominant, but dominance without exclusivity is a different kind of power. It's softer, more conditional. And markets are incredibly sensitive to that distinction. From a historical perspective, this moment rhymes with previous transitions. After World War II, the dollar replaced the pound because the US was the world's creditor, not its debtor. Today, the US is the largest debtor in history. That doesn't mean collapse, it means constraint. It means policy choices matter more, mistakes cost more, and confidence must be actively maintained rather than assumed. China's decision to accept losses rather than remain overexposed suggests it believes those constraints are tightening. For individuals watching this unfold, the lesson isn't panic, it's awareness. The traditional 40-60 portfolio was built for a world of falling rates and stable bonds. That world may not be coming back anytime soon. When bonds and stocks fall together, diversification has to be rethought. This is why education around real assets, duration risk, and monetary history is becoming more important than ever. Understanding how interest rates affect bond prices, how inflation erodes purchasing power, and why precious metals behave the way they do gives you tools, not predictions. China's $688 billion exit is a case study in adapting to reality. It shows that even the biggest players cannot ignore math, incentives, and geopolitical risk. Losses were taken not because China failed, but because holding on carried even greater risk. That's a subtle but powerful distinction. In finance, avoiding a larger loss is often more important than chasing a perfect outcome. As this shift continues, expect more moments that feel confusing. Rising yields alongside rising gold, strong economic data paired with financial stress, markets sending mixed signals. These are not contradictions, they are symptoms of transition, and transitions are always uncomfortable, especially when they involve the core instruments of global trust. In the end, this story isn't really about China or the US. It's about a system adjusting to limits it can no longer ignore. Debt has a cost, trust has a price, and safety is never permanent. Understanding that reality is the first step toward navigating what comes next. In summary, China's nearly $688 billion reduction in U.S. Treasury holdings wasn't a sudden rejection of the dollar, but a calculated response to rising interest rates, inflation-driven losses, geopolitical risk, and a changing global order. By selling into a falling bond market, China accepted record-scale losses to reduce long-term exposure, signaling a broader reassessment of what safe really means. The consequences ripple through higher yields, more volatile markets, growing pressure on U.S. finances, and renewed interest in gold and silver as neutral stores of value. This moment marks not a collapse, but a turning point, where the rules of money, trust, and risk are being rewritten in real time.